Well, good evening and welcome to this live stream on the 20th of January 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thank you for taking some of the time out of your Tuesday evening to spend it with us. Really appreciate it. And we're going to have a really interesting conversation this evening about the property dynamics and can we still, even with the latest legislation coming in, can we talk about property prices going down? Is it, you know, blasphemy, as Cookies just said, or what something else? I don't know. Be interesting to see as we go this evening. Before I bring Aaron in, he's teed up ready to come in a moment. I'll just remind you that we're not providing specific financial or legal or property advice. This is a general conversation only. We moderate the chat, but feel free to throw questions, comments, suggestions as we go. And if you'd like to make sure that the question comes into my queue, if you use that What the World DFA, you'll be able to get that in my queue. I've also enabled Super Chat, which means you can get your question to the top of the list or indeed make a contribution to what we do around here. We really appreciate those who support us via Super Chat, via Patreon, or indeed via PayPal. It really helps to keep the show on the road, literally. So thanks for all your support. It really is appreciated. Anyway, with that done, let me bring Aaron straight in. Aaron, welcome back. How are you?
Hello, Martin. Yeah, good. Happy New Year to you and to all the Walk the World followers and viewers as well. It's great to be back with you. I was just having a little chuckle to myself because I saw Cookie Boy's comment there about property blasphemy. So I don't know. We might be asking for some forgiveness by the end of this evening. We'll see how we go.
Yeah, that's exactly right. Well, it is, of course, the universal truth believed by most people in Australia that property prices can only ever go one way, up, 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 up. However, as we will see, even totality has to concede that sometimes property prices don't always go up. But of course, more importantly, as you and I both say, you can't just talk about averages. You've got to actually look at the detail a bit. And I think that's one of the things I always come back to, Aaron. It's really important to get a little bit more granular, to understand a little bit more about what's going on. I guess we should just, for those who may not have come across you before, just mention the fact that, of course, you are BRight agent, and here is the website Grab, and of course, it's a comparison site that you run and an app that you run, which helps people to find, hopefully, good value real estate agents, and be interested just to get a little bit of sense of how that's going for you and where your apps can be found and all of those things. So I'll let you just run off that a little bit, and then we'll go on with the show.
Sure, fantastic. Thank you. Before everybody sort of logs off, we're not real estate agents. We don't sell houses. We don't sell property. We're not aligned to REA Group or Domain or Ray White or anybody else for that matter. But we realized a few years ago that there wasn't a very good real estate comparison service to compare agents and get great prices. You've got Webjet if you want to fly somewhere. You've got Trivago for hotels. And there's certainly places you can go and compare sort of static rates from agents. That might show sort of an agent. It'll work for 2.5% or something like that on the screen. But what happens if that agent would work for 2.3%? And, you can save yourself a few $1,000s. Or, maybe they're having a slow month, same agent, they'll be happy to work for 2%. And so all we did was basically use an app to leverage the competition that's already in the market and create that benefit for homeowners. It's a completely free service for homeowners. And we thought that it's your house, it's your property, it's your equity. You've worked bloody hard to put a lot of equity into that property, and you should be able to maximize that and get really sort of make the agents really competitively work for you in terms of getting a good commission rate offering. And so that's essentially what we do. The app is going really well. The service is Australia-wide. And this year, we're exploring some partnerships, not especially with real estate networks, but in the consumer sector. So we're looking at other consumer comparison sites and whether they're looking to foray into the property sector. Again, just to give people choice and transparency and be able to leverage that competition that you've worked bloody hard for to get that equity into your house. And we think you should keep more of it.
Yeah, well, thanks, Aaron, and I all power to your elbow because unfortunately, a lot of people still, I think, are paying way too much for the help that they get from the real estate agents. As we've often discussed with Edwin, it's not a matter of just the price, but actually price is important. And I'm a great believer in people, finding out for themselves where the best deals are. So the links and things are below. Now let's just talk a little bit about property more broadly. And I actually made a show with John Adams. It's actually on the Interests of the People channel the other day, and it was called 12.3 million Australians are living in economic Armageddon. And John basically was highlighting some of the stuff that he spoke about a few years ago with regard to the pressure on households, and used some of my data as well. And we went through some of that because, of course, last week in the show, I actually discussed the latest information from my surveys and highlighted that from a financial perspective, many households were a little bit under the gun with cash flow pressures and all of those things. And there's a lot of uncertainty out there. Whether you think about Trump and what Trump is up to, or whether you think about the stuff locally in Australia with regards to the legislation that's milling around at the moment, and what is truth and what is free speech, all those things. But the fact is, economically speaking, we do have some interesting questions. Now, I also made a show the other day. Could an alien invasion spark a banking crisis? Because, of course, there was a report in the Times over the weekend that the Bank of England was warning about the fact that if anybody ever announced that, in fact, there was life and that we'd actually had been visited by little green men or something else, as opposed to big orange men, I suppose, that might actually create a banking crisis. So, the question then is, well, what black swans are there out there, or the liquidity black swans? I mean, I could go on for a long time about the risk. But the point is that for many people, whatever is going on out there in the big wide world, what's happening with property is actually probably one of the most critical questions for them. And so I guess what I wanted to do today with Aaron was to kick around some of those issues. Now, okay, we could talk about Davos and everyone's sitting there in the in the summer, winter sunshine, wherever you want to look, and they all came in on their own jets, of course, looking pretty great. So for the 1%, it's all great, but for a lot of people, the truth is we've got the situation, as I made a show the other day. The mortgage rates, fixed rates are going up. The expectation is that the implied forward rate, this is from the ASX 30-day interbank, is also going up. It's still above 4% in 2027. And as Cookie sent me just before, the Cook said that markets are pricing in about 35 basis points of interest rate hikes by the end of 2026. And the next 2 weeks will have a huge influence on how accurate that pricing will be. Absolutely, it is. Now, let's see how that plays out. But I noticed that Alan Kohler actually the other day over the weekend on the ABC said he doesn't think interest rates are going to go up over the next year or two. But the truth is, of course, nobody quite knows. But if you actually look at it a different way, this is actually the latest in terms of the 2-year bond rate. And you can see here that the 2-year rate in Australia is now 4.088, which is, well, quite a lot higher than it's been for a little while. And the expectation, I think, has to be that we are going to see the issue of rates going higher. Now, the question is, of course, will the RBA do anything when they meet? Well, possibly so. This is a little interesting comment from Greg saying RBA doesn't need to hike rates when the local banks already hiked for them. Indeed. So fixed rates are up. The reason that fixed rates are up, of course, is because the fact is that the implied forward rate for fixed rates is a combination of the bond yield and also the current rates. And so the mathematical calculation based on where bond rates are is that fixed rates are going up, which is why some banks, including people like CBA and Macquarie, recently put their fixed rates up. The question will be whether the variable rate goes up too. So that's the sort of the financial backcloth here, an expectation of higher rates. But Adam, I remember that when you came on last time, you actually wore a snorkel. And it was a bit of a warning, wasn't it? Because at the time you were saying, particularly first-time buyers should be a little bit cautious about how they thought about things. You brought it back, right? So compared with where we were, with now what we're seeing, what do you think the water level is doing? And, is a snorkel enough?
Yeah, well, I look, a snorkel is it might keep you afloat and it might keep you breathing underwater, but make no mistake about it, and metaphorically speaking, you're still underwater. It's not a great place to be, and so I guess if anybody wants to go back and check that episode, I think it was November or something last year. We spoke about how particularly first home buyers using the federal government's expanded 5% deposit scheme are really, really swimming with just sort of the tip of their nose above the waterline, because they have so little sort of equity in the property that it wouldn't take much more than a ripple through the markets to be able to send them underwater. And we're talking about, from just sort of a fortnightly or monthly affordability perspective there, you're borrowing 95% means you're absolutely borrowing to your gills. And I think the irony is, if you think about that scheme being designed for people who can't reasonably save a 20% deposit, maybe they're not in the highest paying jobs and whatnot, they're being asked to pay the highest rates for their mortgages, and then also they have to pay back a higher amount of money on top of that. So it's almost like a double irony there in terms of what those people are being asked to repay. Swimming with your snorkel on, your life support, if you will, is never a good idea for riding out any sort of black swan event. Or last time we spoke about other things that can pop up as well. It might be a health concern. It might be a family member needs some support. It might be a tree falls on your property. Maybe little green men do turn up, and I hope they take gold. I saw that there's a couple of comments already this evening about the price of gold, and David Taylor from ABC Business sort of made a comment on X on the price of gold as well, basically saying, up over $7,000, that tells you that something's not all right. The fact that people are flocking to these safe havens means that a black swan event could be just around the corner. And if you're swimming with so little of your head above the water without much wiggle room, then it doesn't take much to send you underwater.
Yeah, and I'm just going to put the gold price up. I've actually picked up the wrong one. Hang on. There you go. There's the gold price. Yeah, so gold price up at 4,732. That's US dollars, of course. And the recent Trump comments about Greenland have actually perhaps shaken the markets a little bit too. It's all part of the same story. But of course, a lot of people are actually saying, well, traditionally we've held property because property is where all the action's been, and prices only ever go one way. Well, yeah, maybe not. It's interesting. CoreLogic just published some quite interesting. This is actually the calendar year change for the National Home Value Index. Now, this is, of course, the aggregate for the whole country. And Cotality basically says, well, if you go back over from 1985 onwards, you can see that most years prices have actually gone up. In fact, they said that the residential real estate total market was 12.3 trillion. The values were up 2.9%, and et cetera, et cetera. But here's the really interesting thing. A 40-year retrospective in growth from Cotality shows that Australia's housing market has a long history of defying conventional wisdom, with periods of extraordinary growth without under unexpected conditions. And the top growth periods were 1988, 2021, 2003, 2001, and 1987. And that 2025 ranked the highest 11th calendar year for growth across the past 40 years. Now, the problem I've got with that, Aaron, is that the information contained there is right, but wrong. What I mean by that is that's an aggregate average across the whole of the country, right? If you were to do that calculation in Melbourne, for example, then what you would see is that actually the price falls in the last 2 or 3 years have been significant. If we were to look at Perth over the last 40 years, then again, the story will be very different. And I got a real problem with this sort of aggregate top line, see, everything's fine sort of story. And I think this chart, I would say, is one of the most misleading charts I have ever seen, ever. Shame on Cautality for putting it out there, because it is completely misleading. And I don't know quite why they did it. Maybe there's actually a little bit of a concern about property prices not rising. But the truth is that this is a very, very misleading storyline. And I'm quite annoyed, really, about the fact that that's what they've done. Now, I can quote to you, North Ryde Apartments, which is the one I keep using as a case study, right? They reached their peak in 2017, and they've been falling ever since, right? I can also point to areas in Melbourne now where prices are quite a long way down. And I can point to areas away from Sydney, maybe down towards the Illawarra and further south, where in fact, again, prices are lower. So I don't want people to be misled by the idea that property is such a safe bet always. Depends on what you buy, where you buy, and all those things. And I don't know what you felt about that particular piece of data from Cautality, but I was pretty miffed, really, when I saw it.
Well, I don't know if it's in the queue to show tonight, or maybe you can pull it up. I posted, and I think I tagged you on X. It made me think of that Titanic scene where the ship's sort of architect, I think the ship's designer, sort of has this moment of horror 3/4 of the way through the film where he says, "But this ship can't sink." And I think that in that moment, he genuinely believes it too. It's not just a sort of a fanciful media grab or a headline. I think that his genuine belief is that the ship can't sink. Australian property can't decline. I mean, and when you look at those sort of figures from Cautality, you could come up with the same shock and horror, if the ship starts going down. And it would only take a little bit of water, particularly if you're a third-tier passenger, so to speak, for that ship to start taking on water. And the response, I think, from the engineer is that it's made of iron. Of course, it can sink. It can and will. It's a mathematical certainty. So there's a lot to be said for the power of belief, but it goes both ways. And sometimes I think that hopes and dreams and ships and markets built on belief that it will never go down is sort of leading people astray.
Yes, and I think that, one of the themes I often explore with Edwin is the idea of do your due diligence, make sure that you've actually got the granular data for the local area that you're looking at, rather than just taking this high level, 10% up or whatever it is, because of course there are always local circumstances. And more than ever, I'm getting concerned at the moment about people getting swept up into the property sector at this time when interest rates are looking as though they could be rising rather than falling, where the supply of new properties available of quality are actually falling. And in fact, listings are still relatively weak. Again, I covered that with Edwin yesterday. We had a quick recall with Edwin yesterday. He was on his way to Hong Kong and China. Yeah. It was quite funny because he was expected to be in Hong Kong at that point and was going to phone me from Hong Kong and we'd have a conversation there, but he didn't actually leave the country until quite a lot later. He did make it, I understand, but it's quite interesting. And it's just going back to the home buyer thing and the first-time buyers. This AFR article is quite interesting because it basically said that the home loan scheme has sent buyers to the fringe, and that the rate of first home buyers can save has been outpaced by home price growth, especially in suburbs that are eligible for Labour's 5% deposit scheme. And they actually published this little piece of data that showed the proportion of suburbs at or below the price cap in August 25 and December 25. And you can see there that, there's less and less properties effectively that are available now. So there's a real problem with regard to this whole scheme. And look, I'm afraid that the government's partly responsible. That whole first home buyer shenanigans is creating more contention in the property market and creating more risk for people. And going back to your snorkel analogy, because of the fact that the risk profile actually is a little higher for many households, the banks are still charging more for people on some of these schemes, despite the fact that the government said they wouldn't. But in fact, I'm seeing data through my one-on-one conversations that people actually are being charged more for those mortgages. So not only are they having to take a 95% mortgage rather than 80% mortgage, which means, of course, the interest rate is calculated on a bigger base, but the interest rate is also a little higher. And so what you're finding in the analysis that I'm doing with first-time buyers is that people have had to buy further out. They've tended to buy property of perhaps less quality to be able to actually try and find something. And then, of course, what they're doing is finding that they're underwater with regard to cash flow. So we're seeing in some cases 50 to 55 or even 6% of net available income going to pay that mortgage. Now, if you actually believe, as Totality would want you to believe, that prices are going to ever go up, then you might say, well, okay, I can sit there and adjust and accept that later I'll make money on the property, so that'll be good, the capital appreciation. But when you actually do the math, the amount of capital appreciation that you would need over the sort of the next few years to be able to actually deal with the pressures that you've got now are actually almost impossible to actually get. And so therefore what you're finding, I think, is that people begin to realize that they've actually got a tiger by the tail. So they've committed themselves now for this big mortgage. They were expecting interest rates would come down. They're not going to come down. And that's putting, and the final point, of course, here is that the real income growth, as I discussed with John and I've shown on my shows previously, it's not rising. So people are not getting that kick from more income growth than they did in the early 2000s when I was looking at this trend where we had very strong price growth, we had very strong income growth, so people were able to manage it. But it's not really the case now. So we've got this problem that I think is building. And I've got a real concern about some of those first-time buyers who I think have almost been tricked into going into the market. Plus, of course, the Productivity Commission's always said, trouble is with these incentives, it brings forward people who were going to buy anyway, maybe a few months, but it doesn't actually help housing affordability for those people who could never have done it anyway. And so you've got this massive cohort of people who are caught in the rental sector because they've got no choice but to stay in the rental sector. And, they're still struggling with regard to the rent story. And, there's lots of different reports. There was this one from Domain that said, well, maybe the rental growth is a little bit less severe than it was. And they actually quoted some of these rises that look quite benign. But I noticed that the realestate.com.au people put out a report very recently, and they've suggested that maybe we've got a different story with regard to rents, and maybe the rental story is growing quite high. And when you put all this together, you got to say that there are people who are caught now with this question: should I buy? Should I not buy? The government's wanting me to buy, but the truth is that the rentals are experiencing strong growth. The December quarter rose 4.8% compared to the previous year, adding an extra $1,560 annually to rental costs. And then they go and look at it more granularly as well. So there's a big issue here with regards to trying to actually figure out, for people who are in the rental sector, do I believe the government? Do I actually pile in and get that property further out, leverage up to the hilt, or do I not? And that gives me an example, going back to your analogy of the snorkel, right? There are still people holding onto their snorkels saying, maybe I should dive in. I'm really concerned about this. I do believe that this has got to be a really, really cautious time for first-time buyers. Now, the other point I want to highlight, and it's one that you brought to the fore a little while ago in one of your releases, is there's another strategy that people are actually using called rent investing. So rather than buying a property, maybe a property I don't want to live in or a property that doesn't really work, what you do is you actually go for the rent to invest strategy too. And there was a very interesting article here from the Finch Review again. Gen Z turns to rent vesting as financial necessity amid record prices. And that this article said record home prices are pushing an increasing number of aspiring young home buyers towards rent vesting, through which they buy their first home as an investment property while continuing to rent accommodation in their preferred location nearer their work at the city centre. And there's data there. Now, you actually made a very interesting release warning about property investing. And I do think that some of the rent investors are being tricked.
Yeah, indeed. And I guess, again, to emphasize, not financial advice by any measure, but you've got to really look carefully at whether you should buy an investment property as your first property, because once you do buy it as an investment, you won't be able to claim it later on as a principal place of residence, sorry, for tax purposes. Even if you move into it later, it'll still be counted as an investment for tax purposes. The other thing is you may well blow your first homeowner grants and other grants that you're eligible for. You won't be able to get them on that property because it's not bought as a principal place of residence; it's bought as an investment. And thirdly, and I'm not discounting that there is some utility behind buyers agencies, but you've got to be really careful as to what you're buying and what you're being sold. And I think you highlighted on your show last night, a lot of people are perhaps buying sight unseen and perhaps in these outer ring areas, or perhaps in floodplains. It's tragic what's just happened in Queensland. Tragic what's happened with the fires in Victoria. But if you're essentially buying in one of these high risk areas, not doing your due diligence, blowing your ability to buy a first home with grants and incentives in the future, and not getting a tax break when all is said and done, you'd really have to question whether rent vesting, or as it used to be called, buying an investment property and staying with mum and dad, or staying in a share house. It's a bit of a modern sort of term, this rent vesting, but essentially it's always happened. You'd have to question whether that is the right strategy at all. And I think a lot of these sort of outer ring areas are going to see some price declines throughout this year. Thinking of Victoria particularly. I was watching a show about Elizabeth in just out of Adelaide, and the declines that have happened in that area over the years. Essentially, when major manufacturing moves out of an area, you often see a price decline, and you go from towns or satellite cities with hundreds of thousands of people down to tens of thousands, and in some of the more remote, and particularly mining areas, we may be talking tens of people remaining in that town. You'd have to be thinking, well, what kind of investment prospects are there? Whyalla Steelworks comes to mind, with that closure. I think around Mount Isa and Gladstone in Queensland, around those areas. I think the NDIS scheme is going to be under some pressure this year. So, again, some people have been advocating to buy NDIS homes. I think that will all come under some pressure this year and probably for several years to come. So you really have to do your due diligence. You should probably get some financial qualified and sort of reputable financial assistance as well, and make sure that the properties you're looking at have all the due diligence in place. You're not buying sight unseen through buyers advocates that don't live in the local area and are not advocating in your best interests.
Yes, absolutely. And it's interesting, the Elizabeth story, and I recommend, if you've not seen it, it was actually one of those ABC shows that took the story of Elizabeth. So Elizabeth was effectively a new suburb outside Adelaide. It was government invested. They built a lot of quite reasonable homes, laid out the whole place, got industrial investment to come in as well. We had car manufacturing there for quite a long period of time, and it almost sounded like an ideal environment. In fact, there was pictures of the Queen visiting, the previous Queen, when she was there, and everyone looked, amazed at how wonderfully well it was going. But things turned, and the industrial investment left. The property has decayed, and now Elizabeth, of course, is one of the most depressed areas in and around Adelaide, despite the fact that it's sort of gobbled up into the greater Adelaide story. So the Elizabeth story, I think, is a really, really important message here, that about, you've got to ask the question, what is the economic base that's supporting the economy and supporting property price growth at the moment? And as we shrink the amount of industrial momentum in Australia, what does that mean for the property market? Is it actually going to follow Elizabeth? And are we going to find that we're going to see more prices slide? Now, okay, the story, of course, is, well, yeah, hard to see how that's going to happen when, of course, we have massive migration. And I think, we have to come back to the migration story, of course, because the truth is that the migration story is a very important part of the story. And there was this aggregate data picture that I saw the other day showing that we've got, long-term movements. Now, this isn't migration. This is actually movements of people coming in and out, just to be clear. But we've got over 1 million people arriving. And that's putting a lot of extra demand on property in a number of areas. And so people are saying, well, for as long as that continues, that will actually mean that it's unlikely that prices will fall. But the truth is, of course, that may not continue. And there is a debate, well, for as long as we can have a debate about migration and, what is the right settings for migration? Can we match the migration input with the build programs that we need? Now we're actually not building enough properties even to meet the demand we've got today, let alone the migration. So there's a reason why the migration lever is still pulled hard to import, I think, to try and support prices. But if that were to change, that could actually be, I think, quite a significant different issue. And then the other thing I wanted to touch on, coming right back to your point about property investors, I am amazed how property investors don't seem to get the mechanics and economics of property investing. It seems to me that a lot of people are thinking only about the aspiration of capital appreciation. And of course, quite often there are other things. And in fact, Jason made this point about, the Victorian government might be in trouble if their expected windfall gains tax revenue won't be paid if prices go down. So there's another reason why prices, they don't want prices to go down. But my point is, not only the government, but actually individual property investors are basically banking on property price appreciation. Now, that may or may not happen, but there's another metric that I think people should be more aware of, and that's the net investment yield. So that's a comparison between the money that you're having to pay to keep the property mortgaged, maintained, managed, and all of those things relative to the rental income that you can actually get from it. And when I look at that, what I find quite often is that people actually are underwater from a net investment return perspective. So net interest, coming in, going out, all of those things. And so from a cash flow perspective, people are actually underwater. Now, okay, they can off-write those losses in their tax against other income if they've got other income. And of course, people say, well, from a tax perspective, it just means I pay less tax overall. But just think about it. Your investment on a cash flow basis is actually not actually adding value on a cash flow basis. You're therefore banking on capital appreciation. And, if you think about capital appreciation, well, you might get capital appreciation over a period of time, but then you've got to sell the property to get the capital appreciation. You have to pay all of the costs of transactions. And so when you put the math together, what you find quite often is that even from an economic perspective, including the value added, you're still underwater. And then you've got to compare that with other investments like, I suppose, precious metals at the moment and other things too. So this whole story of property investment and the way that it's been sold as a surefire way to make shed loads of money. I mean, there are so many, YouTubes about this and other articles and everything else. I bought my first property and I then leveraged up to get my second and then my third and then my fourth and my fifth. And I've got 30 properties and I'm doing great. Well, when you actually look at the total picture of money in, money out, maybe not so much. So there is a myth here, I think, Aaron, with regard to investment property. And I think your earlier release should prompt people just to say, well, hang on a moment. Let's just kick the tires on this and make sure that it makes sense.
Yeah, absolutely. And, I'll add a few more things to that list as well. You've got property insurance. That's only going in one direction, particularly, again, with floods and fires and all the rest. You've got land taxes going in one direction. You've got electricity prices, I think, up around 40% or so. Now, okay, you might be able to pass some of that on, but then you get to the limit of rental affordability as well, and so you're not going to be able to pass all of it on. Two other points that sort of come to mind, just that tie into what you were saying. You've got to look at capital growth versus the mortgage rate as well, essentially. So if I know it's a sort of a crude way to look at it and think about it, but if your property is going up 5.5% and your mortgage is at 5.5%, then really all you're doing is shoveling your money into the bank's train boilers to produce steam, but you're not really going anywhere. And you're going to keep shoveling and keep shoveling and keep shoveling. And you can probably bet that the capital appreciation goes down at a slower rate than your mortgage rate will go down as well. And so the banks need to stay profitable, which means you need to stay mortgaged as well. And now, again, I'm not against people getting a mortgage, but you need to look at the rate you're paying. You need to look at the growth of your property, and make sure that again you are growing, your property is growing greater at a greater rate than your mortgage is growing as well. And then the final thing on that is your selling costs as well. So your mortgage might go down over 5 years that you hold the property, 10, 20 years, hopefully even longer. But guess what? Your selling costs they don't go anywhere. They're pegged to not to how much you have remaining on your loan, how much equity you've built up. They're pegged to the final selling price, and it's the gross selling price. It's not even sort of net other expenses and things like that. The agent gets paid first, and so you need to make sure you factor in that a couple of percent, not on the amount remaining, but on your top line when you go to sell as well. So lots and lots to think about. And I think people need to do all of that and work all of that out before they jump in.
Well, one of the things I quite often do is to help people by putting those different line items into a bit of a spreadsheet and look at it over a number of years and, ask the question, so what capital appreciation would you need over what period to net be ahead, right? And people are quite surprised often. And then we say, well, you mentioned the insurance costs. They're going up dramatically, of course, as well. Maintenance costs. So people often don't put some money into a sinking fund to be able to actually do the ongoing maintenance of the property. Agents' fees for rental management are still very high and rising. Strata fees, which is a killer at the moment, particularly for relatively new properties that have got defects where in fact the extra costs are being factored back in. So all of those things need to be able to actually be plugged in to be able to understand. And one way I represent that is actually through these maps. So this is actually a map of net investment yield. This is actually looking centered on 2000 postcode in the center of Sydney, right? And so I basically do this calculation based on the surveys. And you can see here that the reds are under 1.6%. And the blues are over 0.9% positive. And you can see in and around the centre of Sydney, there's very little that's actually positive. Newtown 2042 is just positive, and there's a couple of others that are not far away. But overall, on a net rental basis, actually in and around Sydney, most property investors on a cash flow basis are actually underwater. Now that's a story that is I haven't heard anybody else tell it, but I think it's a really important one, right? And if you were to go to, let's go to Melbourne just to sort of make a comparison here. This is Melbourne 3000. We'll start on there. Similar story. Again, what we're finding is that there's a lot of negativity. And look at the deep reds. So in the outer suburban ring of Melbourne, there's a lot of negativity. Now, of course, there are extra taxes on investment properties in Melbourne, as Jason said earlier on. And there's an expectation of the government there if they're going to get a lot of income, or maybe they won't. There's a few that, maybe are okay. But actually, overall, in the greater Melbourne area, it's a pretty sad and sorry state as to what's going on. And that really is a bit of a concern. I don't think people understand this picture, and I think it's an important picture. Now, if we were to go to Brisbane, Brisbane's a little bit different, of course, because the story there is that prices were quite a lot lower, although they're rising fast now. And so we have more properties in the greater Brisbane area that are actually positive, light blue, or maybe even few that are dark blue if we pull out far enough. But again, there are areas where, again, people are underwater. And in fact, as the capital costs of property rises, Queensland, it's going to be more and more likely that more property investors in the greater Queensland area and greater Brisbane area in particular are going to be under the pump when it comes to cash flow appreciation. Oh, and if we just look at Perth, seeing as you're over that way, Aaron, we'll just look at Perth as well, just to show a little bit of a story here. Now, here in Perth, there are some positives. West Leederville, for example, 6007, not bad. But if you look North Perth and other areas too, there are areas again where, from a cash flow perspective, people are underwater. Now, okay, you might make returns on capital appreciation, but this is a killer picture for many people, and it's one that I don't think people understand. So this is a classic example to me of the property investment story and people being underwater, and they don't even realize it.
And once you're there, it doesn't take, as I said earlier, it doesn't take much of a ripple through life really to force you to sell, to move back in with the parents, to have to look after a loved one, whatever it is. It might not all be all sort of bad news, a new child or something like that, and suddenly you're forced to sell up. You're sort of indebted. You're not going to get much forgiveness in terms of paying selling costs and things like that. And you are back to square one, and you may have burnt your bridges with regards to first homeowner grants and deposit schemes and stamp duty concessions and all of that kind of stuff. And I really feel for people that are getting so leveraged to the eyeballs. I wish them all the best, but you just really need to take it cautiously, I think.
Yeah, absolutely. And then there's another little angle here, which I think we should explore. And by the way, Jason, I just want to re-acknowledge what you just said there, which is really important. Even with investment property paid off with cash, yields are less than interest would have been for a term deposit. And that's, of course, the point, right? So if you run alternative scenarios on other investment opportunities, particularly with where rates are at the moment, actually quite often you'll find even a simple term deposit will do better, or indeed, some of the other investment classes out there. So I'm not sure that property is this lay down misere. Yes, it always goes up and always make money. Some will, of course, but a lot won't. And somebody else made the point. I think it was quite an interesting observation. Yeah, negative geared lifestyle is a choice. People do choose to do it, but there are risks attached, particularly with this interest rate rise. And it is significant, I think. And in fact, this is an interesting question just come in. I've heard that the costs 44% now to rent a house in Australia since 2019. Wages have only risen 14%. Yeah. So the point there is what you should be doing is comparing real wages and real rents, right? So actually in real terms, so after inflation, there's been no growth in real incomes. No growth in real incomes for many people since about 2008, 2009, 2010, depending on where you start from. If you were to compare the growth of rents over the same period, they have accelerated away. And in fact, in some places, in real terms, the cost of renting is now double what it was. So it's a huge gradient and a huge difference between the real incomes and the real costs of somewhere to live. And by the way, if you've got a mortgage, because the average mortgage size is a lot bigger, even if the rates come down, most people are paying more today. So 40 to 45% for many people of their net disposable income going on their mortgage repayments too. So yeah, this is just showing you the craziness that we've got.
And it certainly does depend on your time horizon. And I think it's statistics like wages and rents that in some cases lead people to buy property thinking it is the great escape, the only way out. I thought the question of alternate investments would come up today, and I certainly don't want to incur the wrath of Edwin and spruik gold or silver or anything like that. But I thought it would come up, and so gold is up 39% in the last 6 months. Silver is up a staggering 140% in the last 6 months. Now, I'm not suggesting anybody run out and buy gold and silver, but that sort of leads into an article that we wrote a month or so ago now, saying basically don't buy Australian property in 2026, and specifically we're talking about as an investment for a number of the reasons that we've just been speaking about over the last sort of 45 minutes or so. That I think we will start to see a slowdown in capital appreciation. I think we will start to see mortgage rates biting more and more people. I think we probably will start to see migration slow down a touch, whether that's optics or real or recategorization of visas. I'll leave that to other people's judgment. As we've spoken about, high holding costs, high selling costs, and the fact that other investment classes, vehicles, offer great returns as well. So I don't think that the great Australian love of property is necessarily, and again, do your own research, but it's not necessarily the way to go in 2026. I think a lot of other things will do well. Property will probably bite as many or more people than it helps this year.
Well, Jason certainly is on the same path. Don't buy property, look at other asset classes, just my opinion. And, I'll remind you that you can get nearly 5% on a term deposit, because term deposit rates have gone up a little bit as well. And that's relatively risk-free. But the point is liquidity, right? So the point I think people forget with property is liquidity is a problem. In other words, when you actually come to sell it, you've got to go through the process, and that's quite costly, both in terms of time and expense. When you come into property, again, there's a lot of expense on the way in. Although people are cutting corners, as we discussed earlier, quite often what I'm seeing is that people are actually saying, "Oh, I can't afford to get a survey done." So they can't afford to spend the $2,000, $3,000 on a survey because, despite the fact that, as Edwin shows through the rant quite often, you bought this property, but it's got $200,000 worth of problems to solve. So, maybe it would have been a good investment. And so there's this real weird thing going on. And I'll say it again, because I think it's quite amusing. I've had conversations with people, and I asked them, when you last bought a fridge, what process did you go through? And they sort of said, well, I went through this comparison site, and I did this, and I did that, and I found the cheapest, looked at the reviews, and okay, and you went and bought the fridge, right? Okay, and that cost you what, a couple of $1,000s or whatever the fridge was. Okay, now, when you last bought a property, what did you do? And the list of actions that they took was shorter. And the amount of due diligence they did when they were buying their property compared with when they bought that refrigerator, well, it was chalk and cheese. And I'm thinking, well, hang on a moment. This property is the biggest commitment you're probably ever going to make in terms of an investment. And yet a lot of people are doing less in terms of due diligence. And that includes things like surveys, thinking about the planning regulations, thinking about even things like flooding. Is it built on a floodplain? Is it likely to be subject to sea rise? All those things. I mean, there are so many things that people should be doing and yet aren't. And I think it's because quite a lot of people get caught up in the emotion of property purchases, as Edmund quite often says, and of course trusts the agent who believes that the story that the agent's telling is the whole truth, nothing but the truth, when in fact the agents very often deliberately don't tell you everything. It's part of the trick. And of course they want you to get emotionally attached and involved and then actually make the commitment without necessarily doing the work. So there's something weird about the psychology of property. And I suppose it's because people always say, well, property's always gone up, so what's the problem? I'm always going to win on property. But what we're both saying is not necessarily true.
Not necessarily. And I think we shouldn't also discount the stigma that goes along with, and it's often, in a positive and joyous light. I know that was the case, when I bought my first property as well. It's a celebrated occasion, and you tell your friends, I'm now a homeowner, and it's a really proud and sort of big moment, as you say. Your friends don't typically say, well, how much due diligence did you do? Before we pop this sort of champagne cork, is it going to take out a light switch or something like that? It's a celebrated occasion. I think that's part of the national psyche. It can be wonderful, and it could probably lead people to jumping in a bit too early and not really sort of checking the depth of the water, so to speak, on the way. The other, I'd love to get made on a T-shirt. You can't buy groceries with a house brick. I think a lot of people forget. Getting back to the liquidity point there, you can't just walk into Woolies, take a house brick with you, and say, "Well, that's one sort of 2,000th of my house. Can I cash that in and pay for milk and bread this week?" So liquidity, coming back to that, is very important too.
Yeah, some people are saying, back in 2018, there was a likelihood that property prices would fall. And of course, if you look at the ratios between income and property prices, it was very extreme then. And the government intervened, and the government keeps intervening. And the government, of course, has continued to prop the market up. Why? Because there's a risk of financial instability if they actually let property prices fall, because the banks are so leveraged. And also, of course, the wealth effect is positive when prices go up. So a lot of people feel as though, well, I might spend a bit more because I've got a bit more wealth in my property. Plus, of course, a lot of people are using the ATM in the property because value's gone up. So I'll pull more equity out and go and spend it, or take money out and give it down to the kids through Bank of Mum and Dad. All those things are in there. But it is actually a psyche problem. And, the fact is that we are wired in Australia to believe one set of things about property. And it's an inconvenient truth, but sometimes it's not the complete story. And Jason, I think, made a very important point too here. And maybe you should think about doing your app for conveyancers as well as as well as for agents. Because look, the truth is that the conveyancing legal system around property transfer is also riddled with bad practice, poor practice, and people who do the absolute minimum.
Yeah.
I've seen
you could apply it really to any service-based business. One of the frustrating things with the property sector is you walk into an agency, and it's not like walking into a hairdresser where you sort of look up at the wall and see the prices and decide, oh, okay, this is how much I'll pay. You walk through the front door and there's nothing. It's very opaque, and the agent can essentially charge whatever they like whenever they like, according to sort of how busy they are and how much they paid for their BMW and their suit, and all credit to them. But I think people deserve the transparency, and I'm not necessarily saying go for the cheapest agent you can find there either. A lot of people sort of think, oh, well, all you're trying to do is drive down the price. Well, if they come from a reputable company and they're a reputable agent and they can give you a great and transparent price, then power to you. Select whoever you like. You're the homeowner. It's your decision. All we'd like to do is see a bit more price transparency and be able to leverage that competition, which already exists in the market, by the way, for the benefit of the homeowner.
Absolutely. And, you've got to actually understand that there are agendas flying around the place. The government has an agenda, growth at all costs, despite what they say, right? We have the estate agent industry who are seeing very low levels of transactions at the moment. So they're, from an income generation perspective, are somewhat struggling at the moment. And what that means is that they actually are pushing people more towards to try and go into the auction section, because they can actually charge people a bit more to be able to do the auction processes rather than the standard processes. As Edwin always highlights, the fact if you actually compare the work per hour for an agent through a sale process, it's a pretty good deal for the agent, not very good necessarily for the prospective user of that service. And the fact is that if you are buying property, then you need to check off a whole long list of things. And unfortunately, conveyancers quite often do the absolute minimum. Again, I've had engagement with a number of people from my one-to-one service where they actually were told one set of things by the conveyancers, and when they actually looked in more closely and went back to look at the planning regs, they missed blooming obvious things. And in some cases, there's a recourse, in some cases, not recourse. So it does pay to do your due diligence on the agents that you are using, as well as, of course, the conveyancer that you are using, and the other advisory services that you get as part of the property transaction. Again, it is much, much easier to avoid the mistakes in the first place compared with trying to unpick it all afterwards when things go wrong and for various reasons the property value drops, or you suddenly have to incur a lot of extra expense, all of those things. So it is important, I think. Due diligence is something which we keep coming back to on the channel here. I'm not saying don't buy property. I'm just saying buy the right property at the right price through the right processes, and that's what we're trying to get to.
And can I just add, Martin, something I shared with you sort of off air before we started live on the show this evening. The other reason that we sort of titled that article sort of "Don't Buy an Australian Investment Property in 2026" was simply, and it was sort of quite a strong title, was simply to try and bring a little balance back into the conversation about whether or not people should buy, this year or any year, quite frankly. If you go to the major media outlets and REA Group and Domain and have a look on all of their sort of so-called news articles, you will see overwhelmingly, and then clearly they've got a vested interest, but overwhelmingly, they're all about sort of, these are the hot spots to buy. Now you should buy, helping you buy. Now is a great time to buy, what the celebrities are buying, all of that sort of thing. There's never really a balanced article to say, well, look, just hang on a moment. Is this really right for you? Can you get better returns elsewhere? Is this a good use of the deposit you've built up? Maybe you should stay with mum and dad and not engage in rent investing. All of those sorts of things. So, I'm glad that and thanks for just showing the article there. I'm glad it was picked up a little bit because we thought that there needed to be a bit more balance brought back to the conversation.
Yeah, balance is an interesting question. And in fact, in your slides that you sent me beforehand, you started to pose an interesting question, which I want to go on to, right? Because if you think about the relationship between the media and property and the banks, it's a really, really interesting question, right? About who is scared of who, right? And if you look at the pantheon of articles that have come out at the start of the year, all of whom are spruiking property prices to go higher, right? And you got to say the question. And in fact, this little chart here, right? Media scared of the banks. There's some very, very interesting little points here, and it might be worth just you're going through this because I think this is a really fascinating example of what we're talking about.
Yeah, sure. Look, I appreciate that's probably a bit too small on the screen for people to read, so my apologies for that. The reason that picture is as it is because I had to use our own press release as a picture. This article and Martin, I think you get CC'd on a lot of our releases that go out, but this article will not get picked up by the media. I don't know what it is. Well, I do know what it is. I'm going to speculate what it is at least. And perhaps the title of that slide would suggest my thoughts on it. But I suspect that this article is the taboo subject when it comes to Australian property. We sent out, we got picked up by about 20 different mainstream articles throughout 2025. So by and large, they all do really well and they all get a run, except for this one, which is the hidden costs associated with these 5% deposit schemes and essentially taking out a 95% loan. The media just will not run a story that sort of has a crack at the banks and suggests that the banks are overcharging Australian homeowners and people trying to take out a mortgage. Now, I should correct myself on that one. This article did get picked up by a news outlet toward the end of last year and published very briefly. And then I think it was CBA objected to the wording in the article. And then they were basically omitted from the article completely. The whole bank was removed from the article. Now, I noticed that and I got in touch with the journalist and I said, why did you remove that bank from our article? Our reporting was truthful and accurate, and it comes from the bank's own website, for heaven's sakes, and their advertised rates. And that journalist said back to me, oh, yeah, look, it was disputed by the bank. They called us, and so we didn't have time to review it for accuracy, so we just pulled it down. And so I think there is a little bit of scare tactics going on. Perhaps you could argue that the journalists are pushed for time. not able to fact check it. I mean, you can go on to any of the big banks' websites and they boldly advertise their rates, including for borrowers borrowing 95%. The rates are all listed there. So we're not saying anything that is not advertised on the bank's website. But it seems like the mainstream media are running scared a little bit of any sort of article which suggests that the banks are essentially charging people extra costs to get into the housing market. Now, essentially, we think that these 5% deposit schemes, you could argue good, bad, or otherwise. Let's say that they help some people and support some people. Essentially, they should be helping people to home ownership, not helping banks to bigger profits.
Yes. Well, of course, the banks are in for the shareholders and for their own interests. And quite often, what we see is behavior that is clearly orientated in a particular way. They want to provide more loans, they want to provide bigger loans. And, I'm fascinated now when people actually look at some of the releases from the banks about housing affordability, they now assume two full time incomes as the baseline for looking at the comparisons as to what affordability looks like, right? First point. The second point is they assume that the average duration of the loan is a lot longer than it used to be. So in some cases, we're seeing 30-year loans. I've seen some cases where people are getting even longer term loans than that. And so we are seeing bigger loans, longer loans, which means, of course, the banks get ever more interest. And then the final point here is the banks, of course, are big payers of advertising. A lot of advertising will go through to the media and everything else. So it's a bit of a sort of incestuous in terms of that too. And then the final point, there's a very strong correlation between the property portals and the media too. So, when you actually look at what people are actually reporting and the property portals, it's yin and yang. So there is no independent, objective view of the story of property that I see. And, going back to some of the other players who provide a lot of information, they're all spinning it in a very particular way. And in fact, in your slides, you actually made this quite interesting observation, right? So this was the year that was, according to Catality, but it's not really the full story, is it?
No. And, we've got inflation sort of, it seems to be entrenched above 3% at the moment. You've got energy subsidies rolling off. You've got the mortgage cliff didn't happen, and that's a good thing, but mortgage rates still around sort of 5.5% to 6% by and large, and could well be heading higher. There was only 3 cuts throughout the year, and 2025 ended with talk of rates, and so you sort of put all that together, and I think is sort of a caution ahead. The waters have not subsided in the way that I think a lot of people thought they would throughout 2025, despite the property spruiking. And just sort of getting back to that article for a moment, we weren't even having a crack at homeowners or first home buyers. It was really about the government guaranteeing the lender's mortgage insurance for those sort of rates above 80%, and basically saying, look, we accept that banks should and can and do charge higher rates for riskier loans. That makes sense. That's why you pay more for 95% than you do at 80, than you do at sort of 60, 50, 40, 30% loans. If you can pay that loan down, you can get much better rates, and that represents risk to the bank, and that all makes sense. But if the government is guaranteeing the risk of default for those loans above 80%, then why are the banks charging a higher rate for those loans, for those 95% loans? Because they're of no increased risk to the bank to lend out to those people. The government guarantee those any losses that occur. So the banks shouldn't really be charging a rate above that 80% rate to those borrowers, because there is no extra risk to the bank. That was actually the point of the article there.
Absolutely. And I've said this as well a couple of times, that I don't understand why it is that they are charging differentially higher rates, because the risk isn't higher, because it's covered by the government. So they're being, it's a double dip. But
and you're paying that higher rate not just on the extra amount that you're topping up in terms of the deposit, you're paying that extra rate on the entire loan amount too. So that's the other part that doesn't make sense. You could sort of argue, although I think it'd be a weak argument, but you could sort of argue that, well, for that top up amount, pay a higher rate for that. Maybe pay that portion off first off your loan, and then pay down the principal amount, which stays at a lower rate. But that's not the way that the loans are being structured, and they're being charged on the entire amount, on all 95%, at a much, much higher rate. And those jumps are not insignificant. We're not talking about a couple of sort of hundreds or tenths of a percentage. We're talking from sort of, I think in the CBA example, it was about 5.34, jumping up to 6.99, simply because you are borrowing that 95%. And as I mentioned it toward the start of this show, the irony is that those are designed for people who can't afford to save up that 20% deposit. So they're having to borrow more and being charged a greater rate to do so, and there's no more risk to the bank. I just I don't get it, but it's essentially the story that won't be published, Martin.
No, it's a story.
Appreciate you letting me talk about it here, because I don't think people will hear about it really anywhere else.
No, well, I've highlighted it a few times on my channel too, because I think it's a real big con, and you can see it in my data. So these new first-time buyers who are actually paying a higher rate of interest, a greater proportion of their income going to pay that mortgage, and they're under pressure as they go into the story always used to be that, well, the first year or two will be a problem, but incomes will run away faster. And that means that eventually it'll be quite easy to recover. But we're not seeing that. What we're seeing is this perpetual motion machine where, in fact, people are having to put more and more of their net disposable income for housing. And government policy is forcing it even higher. And that is the part of the story that I don't understand. From an economic perspective, it makes little sense at all. People, I think, are beginning to get nervous about it. I've had a few conversations with prospective first-time buyers who are not going to play that game. They're saying, no, I am not going to be forced to pay a higher rate of interest on a bigger mortgage. I will do something different, buy a smaller property or buy further out or whatever it is, but I don't want to dance the tune that the government is playing, because it doesn't make sense and it's unfair. And I think that's a really important observation. So again, I would say to people, do your due diligence when you actually come into this. Don't just assume because the government says, hey, you can have a 5% deposit. It's a natural, lay down as their solution. It's not necessarily so.
No, indeed. Well said.
Now, just one other little thing I wanted to touch on before we close this conversation out. I saw this article, which was quite fun, right? Because they're talking here about tiny homes. So the other solution that people are now spruiking is building a home in your back garden, and the tiny homes are becoming more popular. Some basic models can be bought online for as little as $11,000, but they're talking about clearer rules. And they're talking here, for example, in Queensland, right? So real estate agents and tiny house. So main clients are downsizers looking for a cheaper alternative to retirement homes. And the Queensland received high levels of interstate migration, and a lot of people are looking for property. And so therefore, tiny homes is a solution. Now, I have to tell you, I'm very concerned about this tiny homes revolution, right? The planning rules have been loosened to allow people to do it. So you can put a granny flat in the backyard or whatever. And then I've heard some people say, what I'm going to do is I'm going to actually put a granny flat in the backyard. I'm then going to move into the granny flat and I'm going to let my main property out. I am very concerned about this revolution in housing, which is coming now. And it's another example of, you want to be careful. You could well be swimming against the tide here, literally.
Well, you can save yourself some effort and sleep in your car.
Yeah.
Buy a used car and sleep in the back. In all seriousness, you really have to have a think about what you're buying, whether it meets your needs, whether it's council approved. As you know, and you've pointed out, and Edwin have pointed out on the Monday evening property rants, regulations to do with anything that's sort of habitable, be it a granny flat or a tiny home or a converted shed, and all the rest of it. the government and local councils are sort of putting the screws on people, in an effort to get people to clean up their act and do the right thing. And I applaud that sort of thing. But you wouldn't want to be sort of going against the grain and swimming against the tide, trying to install one of these things only to have the council complain or the neighbours complain. You're forced to demolish it. I'm not sure what the used house tiny home market is like. I suppose if I was buying one to put in the backyard, which I'm not thinking of doing, I would probably buy a new one, quite honestly. And so my point there is that if you decided to do this and then after 12 months you got sick of, weather leaking through your non-waterproof windows and you sort of thought that it was almost the same as living in the back of your car, when you go to sell the thing, who are you going to sell it to, for how much, and who's going to buy it? And so, look, I think this is more spruiking, to be quite honest. I don't really see the upside of sort of the tiny house revolution. Buy a caravan, but at least it's you can move it and meet council regulations and tow it to the next spot every 3 months if that's what your council wants you to do or something. But a lot of people, I've seen sort of articles of people getting into trouble, neighbours complaining, all of this sorts of things. And at the end of the day, you never see articles, about people, having a successful sale of their tiny home. So I think it's quite ludicrous.
Yeah, I'm afraid that the story is, of course, that this is okay for the manufacturers of small homes, and I suppose the government can say, "See, we've included the count of those in the number of new dwellings." I don't know. Maybe that's part of the story.
There's maybe one for Tarek to have a look at.
I think we should. And by the way, Drew's just said that.
Sorry, Tarek, to throw you into that one, mate. But maybe having a look at the ABS reporting of tiny homes and the quality of life. I just can't see it.
No, and Drew's just highlighted the fact that the hate speech bill has passed, so we'll see about that. Now, with regard to the tiny homes thing, interesting comment here. My eldest has had a tiny home for 4 years. It's been great as he saved a mint. I'm not surprised there'll be restrictions, and it is, horses for courses. I think there's a place for it, but I'm just worried about the fact that this is now the new latest great solution to our housing crisis, when in fact the solution to housing is to question, one, migration, two, the lending standards, and a few other things. There are things that could be done, plus of course the tax breaks for the investment properties, all of those things. And I guess as we sort of come towards the end of the show, I just wanted to highlight, in your slides that you sent to me, you also highlighted one other thing, underquoting. And it's very interesting and important to highlight that people should be very careful. And it's interesting that the media have been warning about underquoting a little bit. Sort of.
Yeah, sort of. I mean, thankfully, this is something that that sort of does get picked up from time to time. I mean, every time there's sort of some dodgy agents underquoting, which is, I guess, pretty regularly. We inquired about a property in this sort of area recently that using the property portal sort of sat, if you tweak the filters, it sort of sat under $1 million. And then, of course, you contact the agent and they're taking offers from 1.5 and over. So go figure. But I suggested a few things in that article that people might want to look at in terms of being able to avoid underquoting. The old adage, if it looks too good to be true, then it probably is. Use some tools. Your one-to-one service, Martin, would be great in terms of people getting an appreciation of what to expect in the local area, so that they can keep an eye out for those properties that are marketed too low, and just sort of really allow people to not waste their time sort of chasing those things around that are always going to sell for more. Ask more questions and then ask more again. I think you mentioned earlier during the show that agents always cast a property in the best light. And to be fair, that's what they're there to do. But it's all the things that are not printed in the brochure that you want to be asking questions about. You also need to look at comparable sales. If agents or advocates are saying, "Oh, look, that's this, comparable with these other four properties." Well, were those other properties sold recently? Was that several years ago? Maybe that industry that's in town has since shut down. Maybe there some long-term leases are not being renewed in that area. So just need to sort of watch with the comparables there. And then don't fall into the wishful thinking trap. We would all love to think that we've come across that diamond in the rough that all of the other people browsing through the property portals have somehow missed, and you've found the one that everybody else has missed. But chances are, if everybody else is missing on that property, there's something about it, perhaps something that's not being disclosed, as to why other people aren't jumping at that opportunity. And so again, this sort of doubles back to the wishful thinking part of it. Is just making sure that you really ask why. Why is it? Are there roadworks? Are they demolishing something across the street? Is it office opposite a sewage treatment works? Is there are there two big dogs in the backyard? Sort of, and it's not really friendly for local kids. All that sort of thing. And so appreciate that a lot of that is hard to do remotely. But it's essentially unlikely that you found the diamond in the rough that everybody else has walked past with hundreds of thousands of eyeballs sort of browsing through these properties, and everybody else has missed something, or perhaps it's you that's missed something in there, or something that's even been removed from the listing as to why that place isn't selling. So a few sort of cautionary points there for people.
Thank you very much. And yeah, very interesting and important. The underquoting story does continue, and I keep highlighting it. Get the information. Just thanks to Jason for the super chat. Really appreciate it, Jason. You are a champion when it comes to supporting the channel. So thank you once again, and for your comments as well. And I will just make the point, there was a couple of interesting comments that came in. Snowman asked about what made property an investment, who made property investment, right? And the truth is, of course, there always has been some property investing, but the rules changed about 30 odd years ago, and we got a huge explosion of property investment, significant tax breaks, significant growth in investment lending from the banks. That stoked prices higher. That then created more momentum. The government outsourced the provision of rental accommodation to the private sector. Property investment continued to grow, and then it got fixated in the psyche. Now, in Australia, we have double the amount of property investment compared with, for example, in the UK. So 16% of lending in the UK is for property investment purposes. In Australia, it's more than 30%, 32, 33%. So we are world champions. And as you also say, Snowman, homes are homes, not investment. That's the point, of course. But the problem is that unless you actually have government thinking about housing, like the Elizabeth story that we looked at further on, what are people going to do who can't afford to buy? And the answer is rent. Well, if you're going to rent, who are you going to rent from? Well, of course, up until now, it was mum and dad, small investors. Now, what's happening now is we've got this idea of the commercial build to rent story coming in, and the government's given them even more tax breaks, amazingly. And what that means is now that we've got people building high rise for rent that are corporations, international corporations. They're getting much bigger returns because the rents are higher. They're getting tax breaks as well. So unfortunately, it's institutionalized, and some of those big international investors are actually now going to flood the market with more investment. So I'm not sure that we're going to see the investment back in the bucket. But the tax breaks don't make sense. And a lot of people are suggesting the tax breaks are too generous. I agree. I tend to agree with that. Oh, and by the way, you also made the point about Steve Keen, interestingly, Snowman. Yeah, Steve was on a year or so ago. I've had him on several times. And yeah, we'll get him back on at some point. But the issue with Steve is he's got a very clear thesis about what's the story, but you just get the same thesis again and again. So in a way, it's a question of, do I get new insights when I get Steve on, because he's got a very clear story, and we've told that story a few times. But you can check the earlier live shows and other shows that I've done with Steve. And Jason's just makes the point. I think that's a really interesting point. Coming back to property investment, the property investment worked pre-1985 when CGT was invoked, and before it got ahead of the pack when the rules changed. Yeah, the government's meddled. And I think more generally what I'd say is I want governments to get out of the market, get out of meddling with property, let the property market be the property market. We'd be much better off than we are at the moment. But there you go. Anyway, I think we're pretty much done, Erin. So I want to say thank you very much for spending the time with us this evening and for putting your slides together and sharing your thoughts as always. The truth is we're in an uncomfortable situation with regard to property. The governments have meddled. People have made some bad decisions, and the risks ahead look quite significant. And whether that's underwater because of your debt burden's too high, or whether it's underwater because you've bought a property in a flood zone, there's going to be issues with flooding. I don't know. But I appreciate your insight. Any last thoughts from you? Yeah, snorkel. Go ahead with the snorkel. Go on.
That's right. Keep the snorkel handy, folks. Hey, look, all I would say is tread carefully, go with caution, don't follow the hype, and be well and have an amazing 2026. And appreciate all the support and people sort of continuing to support Martin and the channel. I think what you do here is fantastic and really bringing balance and transparency to the narrative around property, around financial markets more broadly. And so it's a pleasure to be part of that. So thanks very much.
Well, thank you. And I appreciate your support, and we'll keep tip-tacking. I'm sure we'll get you back on the show later in the year. Always insightful when I have a conversation with you. So thank you for that. I'm going to take you offline now, and I'm going to close the show. So thanks, Erin. Okay, so there you go. I hope you found that interesting and informative, and always lots of interesting issues to do with property, of course. Guess what? Next week, I've got Leith Van Onselen coming back on, and Leith and I will be kicking around the latest economic data and trying to make sense of that. So join us for that. Of course, the recorded shows are released daily, and we cover finance, property, and the broader issues with regards to the economy and all those things, and specifically look at some of the international issues too, of course, in my weekly update on a Saturday. The good news is the dogs are still here. They did make a couple of noises earlier on. Yeah, so I had to mute myself earlier when the dogs were woofing a bit, but I think I unmuted myself, so that was good. So thank you very much indeed for the spending time with us this evening. Thank you for the super chats. I hope you have a great evening, and I'll look forward to seeing you on the next show. This is Martin North from Digital Finance Analytics, signing off. Take care.